Welcome to your weekly market recap. The stories that moved the markets this week, all in one place, every week. We've just wrapped up a week that can only be described as a battle of narratives. If you just looked at the Friday closing numbers, you'd see a market that is remarkably resilient, but that headline hides a week of absolute turmoil. Today, we're breaking down a week where the Dow hit a historic record above 53,000, only to be met by a geopolitical gut punch that sent oil prices screaming. We're looking at a massive 21% collapse in Intel that has completely reshuffled the semiconductor landscape, and a staggering $2.7 billion wave of institutional money flowing into Bitcoin ETFs. By the end of this video, you'll see why analysts are calling this a stagflationary cocktail, and why this coming Monday, featuring both the June CPI report and Fed Chair Kevin Warsh's first congressional testimony, might be the most consequential 24 hours for your portfolio this entire year. Let's dive in. It was a week of extreme highs and stressful lows, but the S&P 500 managed to post a winning week, rising more than 1% to close near 7,575. This gain was primarily fueled by a late-week rotation back into big tech, specifically Meta and Nvidia, which acted as a shield against a midweek geopolitical scare. The week actually started on a high note. On Monday, the Dow Jones Industrial Average made history, closing above 53,000 for the first time ever. According to The Street, this marked the Dow's 21st record close of 2026, driven by an AI trade that seemed to be regaining its footing. But that euphoria didn't last long. By Wednesday, the Dow suffered its biggest down day of the week, tumbling 577 points after the geopolitical situation in the Middle East took a dark turn. As we look at the overall mood, it was cautious but resilient. The single biggest driver was the market's growing willingness to look straight through geopolitical shock. Even as the US and Iran traded fresh strikes and the ceasefire was declared dead, volatility stayed relatively subdued, a striking sign that many traders treated the Middle East flare-up as noise rather than a fundamental change in the market regime. However, the deeper tension remained a tug-of-war between a hawkish Fed and a resilient, AI-driven equity market that just wants to keep moving higher. On the flow side, money moved in two clear waves. Early in the week, investors rotated out of the crowded semiconductor trade, selling names like Micron and AMD, and moved into financials, energy, and communications. Then, by Friday, that money rotated back toward big tech leaders while banks provided steady support. The laggards here were small caps and defensive corners like healthcare, underscoring that this was a risk-on rotation, not a flight to safety. The New York Fed's latest survey showed that one-year consumer inflation expectations rose to 3.7%, the highest since September 2023. This creates a massive dilemma for the Fed, an economy that is slowing on labor but staying hot on inflation, a classic stagflationary tilt. Adding fuel to that fire was the sudden collapse of the US-Iran ceasefire. This geopolitical disruption sent Brent crude surging above $80 a barrel intraday. Simultaneously, Russia banned diesel exports through the end of July following Ukrainian drone strikes on its refineries. According to Reuters, U.S. diesel futures saw their biggest one-day gain in 4 years as a result. These two supply shocks hit energy prices at the exact moment the Fed was struggling to bring inflation down, leading the IMF to cut its 2026 global growth forecast to 3.0%. In the bond market, yields responded to these shocks by spiking to 7-week highs. The logic for investors was straightforward. Higher oil prices mean stickier inflation, which means the Fed will likely keep rates higher for longer. The 30-year Treasury yield actually held above 5% for much of the week, a psychological threshold that shows the market is pricing in a persistently high rate environment. We also got the FOMC minutes from the June meeting, and they revealed a Fed that is sharply divided. 9 of the 18 participants now project at least one more rate hike before the end of 2026. Chairman Warsh's first major overhaul involved making these minutes shorter and less informative, but the message was still clear. The committee is flirting with more hikes. This hawkish tilt was echoed by Governor Waller, who stated in Rome that the risks facing the Fed have completely flipped. While he was arguing for cuts a year ago, he now says inflation is taking off, and that changes how policy should be thought about. By week's end, the market's view of the Fed had shifted decisively. Rate cuts have been entirely priced out for this year. The only debate now is whether the Fed hikes once, as their own dot plot suggests, or more aggressively, as Bank of America now forecasts with 3 hikes. One piece of good news for the Fed, despite the volatility, long-term inflation expectations in the bond market stayed anchored. The market is nervous, but it's not panicking yet. If you're finding this breakdown helpful for navigating these choppy markets, take a second to hit that like button and subscribe. It really helps the channel reach more investors like you. We're only halfway through the most critical parts of the week. Stick around because we're about to dive into the massive crash in the chip sector and what's driving those record-breaking crypto inflows. The most dramatic action this week was in the tech sector, specifically the massive sell-off in semiconductors. Intel was the epicenter of the carnage, with its stock cratering about 21%. This was a double body blow for the company. First, reports emerged that their critical 18A manufacturing process is facing delays and won't hit profitable yields until late 2026 or 2027. Then, AMD disclosed that its data center revenue of $5.8 billion had overtaken Intel's $5.1 billion for the first time ever. This effectively shattered the bull case for Intel's comeback, erasing roughly $120 billion from Intel's market cap in just a few days. The pain wasn't limited to Intel. Corning saw its market cap shrink by over $52 billion, plunging 24% in just 4 sessions as investors rotated out of AI infrastructure names. Even SpaceX, on its highly anticipated Nasdaq 100 inclusion day, fell 7% as traders sold the news, despite billions in forced buying from passive funds. However, it wasn't all bad news for the AI trade. While some names fell, others signaled massive long-term commitments. Micron rebounded 7% on Thursday after pledging to invest $250 billion in the U.S. through 2035. We also saw the massive Nasdaq debut of South Korean memory giant SK Hynix, which raised $26.5 billion in the largest ever ADR offering in U.S. history. Since they make the HBM chips for nearly every NVIDIA accelerator, this listing was a major signal that the AI hardware build-out is far from over. Finally, the clear winner of the week was the energy sector. The XLEETF surged as oil prices spiked, and ExxonMobil signaled its Q2 earnings would be roughly $5 billion above Q1. This created a Mag 7 split. Energy-adjacent names like Amazon and Apple held steadier, while Tesla, Meta, and Microsoft saw meaningful declines midweek. Despite the midweek risk-off mood, crypto had a surprisingly constructive week. Bitcoin started near 64,000, dipped to 61,500 on the Iran news, but staged a powerful V-shaped recovery to close near $64,500, a 3.5% weekly gain. The big driver here was institutional money. Ethereum ETFs also had their best week since launch, bringing in roughly $908 million. Sentiment is slowly shifting from fear back toward a cautious recovery. This was helped by President Trump telling reporters, "I'm a big crypto guy," and suggesting Bitcoin could be included in government children's savings programs. Even a massive $216 million sale by Strategy, their largest ever, was absorbed by the market with only a brief price dip. For the first time in months, institutional capital appeared to be rotating back into crypto across both BTC and ETH simultaneously, even as smaller altcoins lagged behind. As we've discussed, oil was the undeniable story of the week. Brent crude hit $80.12 a barrel on Wednesday, its biggest one-day surge since April. The trigger was a sequence of Iranian drone strikes on commercial tankers in the Strait of Hormuz and the subsequent U.S. military response. Since the strait carries one-fifth of the world's oil supply, even the prospect of a closure jolted the market. While it pulled back to $76 by Friday, crude still remained on track for its best weekly gain since March. The secondary shock was Russia's diesel ban, which sent U.S. diesel futures up more than 11% in a single session, the largest daily gain in 4 years. Analysts at Opus are already warning of wholesale diesel price hikes of more than 40 cents per gallon. Precious metals, however, didn't act like the safe havens you might expect. Gold actually fell about 1% for the week. Usually, geopolitical tension is good for gold, but the Iran shock boosted inflation fears and the US dollar, which weighed on gold because it doesn't pay a yield. Silver took an even harder hit, falling nearly 4% to around $60 an ounce. This stagflationary cocktail of rising energy and falling metals suggests that the market is more worried about the Fed's reaction to higher oil than a full-scale global flight to safety. When we step back and look at the whole week, two major threads connect everything. First, we are seeing geopolitical stagflation in real time. The collapse of the Iran ceasefire drove oil and diesel higher, which immediately fueled hawkish Fed rhetoric and rising bond yields, while simultaneously weighing on consumer sentiment and credit. Second, we are witnessing the AI trade maturation. The market is becoming much more selective. We saw a massive rotation out of overextended chip names like Intel and Corning, even as institutional capital chased the theme through the SK Hynix listing and record Bitcoin ETF inflows. The tech-heavy S&P and Nasdaq won the week by shrugging off the drama, while the blue-chip Dow slipped, snapping a 4-week winning streak. The bond market has sent a clear signal. The era of cheap money isn't coming back soon, and the 30-year bond holding above 5% is the ultimate proof of that. Looking to next week, you need to circle Monday, July 14th on your calendar. It is dominated by one event above all others: Fed Chair Kevin Warsh's first ever congressional testimony. This arrives the same morning as the June CPI report. If inflation comes in hot, following May's 4.2% print, and Warsh sounds hawkish, markets could sharply reprice rate hike odds for September. But if CPI surprises to the downside and Warsh is soothing, we could see a rally across both equities and bonds. We also have the official kickoff of Q2 earnings season with the big banks, JP Morgan, Wells Fargo, and Citigroup all report Monday morning. Their commentary on how American companies are handling high rates and energy pressure will be vital. Finally, the House is holding Crypto Week, with votes expected on the Genius Act, which could become the first ever federal crypto regulation in U.S. history. The takeaway for this week is that the market is navigating the worst of both worlds: stagflation anxiety. While big tech is providing a shield for now, the energy supply shocks and the Fed's hawkish tilt are creating a very narrow path for growth. As we head into a week packed with CPI data, bank earnings, and Fed testimony, stay focused on the fundamentals. If you enjoyed this breakdown, please give us a thumbs up and let us know in the comments. Are you more worried about the Fed or the Middle East right now? Thanks for watching, and we'll see you in the next one.